The third prong is distressed property. We have a property in contract in Mississippi. It's an industrial deal. It's not a nice property. I'm not going to pretend that this is Class A industrial, but we're in contract at $12 a foot and have 25 acres more to build on top.
Oh,
of
wow,
it.
that's nice.
It's great. Like there's a fenced yard there that we think we can get between $2,500 and $3,000 an acre for truck parking, and it's 6 acres of the 25. That's $180,000. Is that right? My math? Yeah, $180,000 ish, $50,000 a year. That's not even part of the buildings. Like that's just land that we can lease out. So that goes back to the intrinsic value and the distress. Yeah. The tenant moved out. They left the property in horrible condition. The owner is like, I can't deal with this. I want cash. Get me out. Now, not included in our pro formas for the fund, but I think we're getting into like inside baseball here. So it's a little more complicated. But if you take a distressed deal where at a deal level, you're going to get 30, 40, 50% returns, and you put a GP-LP structure on it. So now the GP is getting a promote on top of it, which that's the fund. The fund as the GP in this distressed deal could be getting 40, 50, 60% IRR. That didn't exist in anybody's imagination other than, occasional development that went right or something 4 years ago. So the opportunities that are in front of us are outstanding. When we did our pro forma and when we did all our slide decks and all our projections and everything else, we went back and changed the returns down because they didn't look feasible. Like people would look at it and say, you guys must be a Ponzi scheme because
ludicrous,
it's
right?
Crazy. But for all of those of us that went through 2008 and 2009 and 10, like everything was on sale.
It was.
And when things are on sale, well, I mean, I'll use that example of the property that we're upside down on. The buyer knows our back's against the wall. They know we're upside down. They just came back and asked for a 8% price reduction the day of contingency removal without a good excuse because they knew we needed to sell. Mm-hmm. It is a buyer's market right now. I'm really frustrated about that as the seller, but I know that there's going to be other sellers that need us like this deal in Mississippi. And, we didn't squeeze them. We're not going back for a price reduction or anything. We told them where it would work for us. We came to an agreement. We're doing it. And there's a lot of opportunities like that out there. I do think, though, that there needs to be a differentiator here. If you look at the big companies, Blackstone, KKR, these big companies, they have distress as well. They have loans expiring. They've also built up these massive distress funds. They're not putting money out yet. And there's kind of conversation saying, well, there's not going to be distress because there's all this money. And to a certain degree, that may be true. But if you think about it being financial distress, if you're a big investor, you can solve your own financial distress.
Right.
Now, on the other end of the spectrum, you have your local investors who all sign personal guarantees with the banks they bank with. They cannot afford not to solve their personal distress. In between that, and I don't have an exact number, let's call it $5 million purchase price to $50 million purchase price. Somewhere in there is where a lot of those syndicators we talked about played. There are people that have maybe a ton of investors in a project. When they go upside down, how do they recapitalize? So if you're a sponsor, and let's say you're 10% in a deal that has $20 million of equity in it, and you have 100 investors, which sounds crazy to us, but there's a lot of groups that had 100, 200, 500 investors in a single deal. How are you going to get them all to agree on how to recapitalize that deal? And that's where we're seeing the opportunity. It's that it's like if you were talking about companies with revenue, you'd call it that middle market type deal size. We're not opposed to doing bigger stuff. Like if it's there, we'll absolutely do it. But our real focus is kind of sub $50 million because we think it's too small for the big distressed funds to play in. If you're Blackstone, your overhead is such you cannot afford to do a $30, $40 million deal. We can. We're a small company. Mm-hmm.